Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Shridevi Classes YouTube channel where we inculcate interest and confidence in science, engineering and management subjects. Today in our project management playlist in chapter financial estimation and projection, we'll understand three important financial terms: profitability, cash flow statement and balance sheet, and we'll understand net profit is the difference of total revenues and total project expenses, and profitability is calculated as percentage of total revenue. Cash flow statement indicate both inflow and outflow of cash in business organization and indicate both sources and use of cash in business project. Balance sheet of any project or company indicate all assets, liabilities and position of equity shareholders at a particular date. These three, profitability, cash flow statement and balance sheet, are very important and we'll study their significance in financial estimation and projection. A thorough understanding of profitability, cash flow statement and balance sheet is very essential in financial estimation and projection of any business organization. These three elements provide valuable insight into company's financial health, performance, potential and future prospects. In this learning video, we will investigate all these three components and explore their significance. Gross profit is calculated by deducing all direct costs from project revenue which are obtained by sales of goods, and in our case it is 19,500, and if we deduce all indirect costs from that, we'll get net profit before tax and it comes as 13,300 for this case, where sales revenue is 50,000, cost of purchase of raw material and services is 30,000, other direct costs are 500, and indirect cost component rent, salary, general expenses, depreciation and interest is 5,200, and this 13,300 is net profit before tax, and if tax amount is 30% of profit and it is 3,990, then net profit after taxation is 9,310, and the percentage of this net profit of total revenue is profitability, and in our case it is 18.62%. Now this profitability measures project ability to generate profit from its operation over a specific period. It can assess profit or loss of project. A positive net profit indicate that project is generating profit, while a negative net profit will indicate loss making position of project. Projections of profitability are based on assumption and estimate of sales that will give us projection of revenue, and estimate of expenses and other financial factor decide profitability projections. In modern financial measurement practices, measures such as return on investment (ROI) and net present value (NPV) are used to assess project profitability. Return on investment is calculated by dividing the project net income by the project total investment, and if a project gave higher amount of return on investment, it means it's a good financial proposition. Net present value calculates the present value of future cash flow that take into account initial investment of the project, and if a project got positive net present value and high return on investment, then one should approve that investment, and if return on investment are low and net present value of project is negative, then one should deny those projects and should not invest in those projects. Cash flow statement is a financial statement that indicate cash inflow and cash outflow of a project over a specified time period. It provides a detailed analysis for project cash position, including its sources and the use of cash. Cash flow statement helps to evaluate the company liquidity status. It can also evaluate its operating activities, all its investing activities, or the financing activity of the project or the company. Operating activities section of cash flow statement indicate cash flow from core business operation such as sales where we receive cash from customer or royalty from user, and it also indicate cash flow for all expenses such as salary paid to employees or commission paid to sales executive, and the net cash from those operating activities is if positive, then it indicate a healthy cash generation, and if it comes negative, then that indicate problematic cash generation condition in cash flow statement. Investing activities of cash flow statement include cash flow from investments such as purchase of assets, machinery, plant, property or equipments, or sale of securities or physical assets. This investing activity part of cash flow indicate insight into the company's investment activities and capital expenditure decisions. Cash flow from financing activities include cash flow from repayment of debts or issue of equity, as here IPO issued got an inflow of cash, and cash flow related to other financing activities. This section of cash flow statement reflects the company's capital structure change, such as issue or repurchase of shares, taking loan, repaying debts. This study of financing activity from cash flow statement helps to assess the company's financial leverage and capital raising activities for the study duration. Balance sheet with asset, liability, and equity positions provide a snapshot or comprehensive picture of financial position of any business entity at a specific point in time. In balance sheet, assets represent all those what company owns, and liability represent what company owes and what payment are due on company, and equity indicate shareholders position in balance sheet. In balance sheet, sum total of liabilities and owner's equity become equal to sum total of assets. This balance sheet serve as a tool for project manager to assess the financial strength, including ability of company to manage debts, availability of assets, and capability to generate profits. Additionally, balance sheet is also used to estimate the future financial performance of the project, and it can also provide key areas where business can make improvements. Left half of balance sheet represent asset part that represent all the resources owned by the company, that include current assets such as cash or equivalent of cash available with the company, all short term investment account which are receivable, and other receivable including inventory and supplies, and some prepaid expenses, all are current asset, and sum total of those is total current assets. It also include long term assets such as property, plant, equipment. As for example, this corporation has a land of rupee in thousand 5500, and it has made investment of land improvement in building construction, equipment procurement, and they all are its long term asset. And if we subtract accumulated depreciation in those long term permanent asset, then we'll get net worth of all permanent assets. There could be some intangible assets like goodwill or other intangible assets, and sum total of all those asset is total asset of organization. Now this asset section of balance sheet show company's different investment and its ability to generate future economic benefits. Top right up part of balance sheet indicates liabilities. Now liability represent company's obligation or debts that include both current liabilities and long term liabilities. Current liabilities include short-term loans or other amounts of payable accounts. This also include accrued compensation and benefits on project, income tax that is required to pay, and other accrued liabilities or deferred revenues make sum total of current liabilities. In long-term liabilities, it include long-term debts, lease, bonds which are payable, or other notes of finance which are payable, or some deferred income tax make it total long-term liabilities. This part of balance sheet liabilities of a company represent company's financial obligation and solvency condition. If we deduce all sum total of liabilities from company assets, we'll get a part of money available, and that is represented in lower side of right half as shareholder equity section, and it represent residual interest in company assets after deducing all liabilities. It include share capital, retained earning of business, or other equity component, and this section of balance sheet reflects the shareholder ownership stake in the company. In conclusion, we can say in financial estimates and projection, analyzing profitability, study of cash flow statement, and analysis of balance sheet is crucial for assessing a company's financial performance, liquidity conditions, and overall financial health. By evaluating key profitability metrics, understanding the cash flow statement, and examining the balance sheet, any investor or stakeholder can make informed decision and make correct projection about company's future prospects. These three elements, profitability, cash flow statement, and balance sheet, provide a valuable insight into company's profitability, cash generation ability, and financial position, and they form a foundation for effective financial estimation and projection. We hope this beautiful learning video has explained three important aspects: profitability, cash flow statement, and balance sheet for financial estimation and projection of any business organization. Our other learning video of the same playlist are equally useful. You can use them in your study and share them with your friends. And if you need dedicated exam-centric notes from this channel, do join our YouTube membership. Happy learning. Have a nice time. Thank you very much.